Hello, and welcome back to another episode of Your Dreaded Economist. That's me. Okay, so I felt so inspired after meeting with my friend Economy the other week. Remember, he thought he was sick. And so I figured maybe we could see what would happen if an economy was sick and what we could do to fix it. So what we're going to take a look at today is monetary policy and fiscal policy. Ooh. Actually, it's pretty boring. We're going to go through it quick. So, ready, set, go!
The first way to correct a sick economy is through monetary policy. Monetary policy is decisions about how to regulate the amount of money available in the economy. This is actually done by the Federal Reserve, or the Fed as we'll look at. They create monetary policy to increase or decrease the amount of money in the system. And then fiscal policy. These are policies that the government makes about taxation and spending in order to promote economic stability and growth in an economy. So let's take a look at what that is on a business cycle. So based on economic activity, monetary policy, done by the Federal Reserve, or fiscal policy, created by the government, can decide to expand and grow our economy by putting money into the economic system through a variety of ways. This causes us to increase or grow in our economy by spending more on GDP. They can also choose to take money away if they feel the need to contract or to decline our economy. Say we're growing too quickly and they want to stabilize things. Today we look at monetary and fiscal policy and how they can influence our economy. So just one more recap from last week. We discussed what do we do if the economy is sick. Well, in the United States, there's two main methods to help cure a sick economy. Like we said, fiscal policy and monetary policy. In times of recessions and depressions, we want to put money into the economy. And whenever we want to slow down an economy and avoid inflation, we have to take money out of the economy. Let's go ahead and start taking a look at monetary policy to see what the Federal Reserve does. History on the Federal Reserve and how monetary policy came to be. It was created in 1913 as a way to regulate the amount of money in the economy because they wanted to decrease unemployment, fight off inflation and recessions, and try to promote economic growth.
Who in the is that?
So the Fed is responsible for regulating banks with laws on what banks can and cannot do. The Federal Reserve is made up of 12 different banks in different regions across the nation, and each of these banks prints our money. The Federal Reserve is also run by a board of governors, and the monetary policy is decided on by a group called the Federal Open Market Committee, or the FOMC. There are three tools the Federal Reserve can use to implement their monetary policy. The first is something known as a reserve. A reserve is a rule where banks must hold on to a percentage of their deposits and not loan them out. This is known as a reserve requirement. The second tool is open market operations. The FOMC regulates the nation's money supply by buying and selling government bonds, securities, and this is known as open market operations. Finally, we have a discount rate, and the discount rate is the interest rate the Federal Reserve charges other banks to borrow money. So let's look at how this would influence the economy. Let's look and see what happens each time the Federal Reserve uses one of their tools to influence the economy, starting with interest rates. Increased interest rates on loans make people borrow less money, which means they spend less. That would be a contraction in the economy, or taking money out of the economy. The second tool to manipulate the economy is increasing the discount rate. So increasing the discount rate makes it harder for banks to borrow money, which means they loan out less money, which means people spend less money. And if they decide to buy bonds from the government, this would increase money circulation, meaning the government and people can spend more money, which means more employees are needed. Putting money into the economy, which increases or grows our economic activity.
Do you know how exciting monetary policy is? It's not.
Changing gears, what about the government's fiscal policy?
Government takes everything we make to pay for all of their solutions. Healthcare, climate change, pollution.
Alright, so fiscal policy are government decisions about taxing and spending designed to promote economic growth and stability. The two tools the government uses are their government spending and taxation. We might see the government use either of these tools in times of recessions and depressions to put money into the economy or to slow down an economy and avoid inflation by reducing the amount of money circulating in an economy. The first tool the government can use is their spending. The government can regulate GDP by increasing or decreasing their spending. Decreasing government spending takes money out of the economy, contracting us. Increasing government spending puts money into the economy, expanding us. So while the government can increase its spending to stimulate the economy, it does have to be careful because too much money in the economy can result in inflation.
I need that money.
The second tool the government can use to increase or decrease the amount of money in the economy is through taxation. Increasing taxes means that we have to pay more to the government and it takes money out of the economy, slowing down our spending. Decreasing taxes puts money into the economy, which means that we pay less money to the government up front and we have more money to spend, stimulating the economy.
Hey, I'm just like any other guy. I pay my taxes one leg at a time.
To wrap up the government's fiscal policy, increasing spending means that they're going to speed up the economy by putting money into it. The downside, possible inflation with too much money in the system. If the government decreases spending, they slow down the economy by not putting money into it, but the perks are we can avoid inflation even though there might be some unemployment occurring and lower GDP. If the government increases taxes, it takes money out of our wallet, so we spend less, so the economy slows down and inflation slows. But if the government decreases taxes, we keep more of our money in our wallets, we spend more, which means an increase in GDP, increase in jobs, but also potentially an increase in inflation.
Okay, well I tried to make that as painless as possible, but as you can see, when we're looking at the health of an economy, like using a business cycle, there are tons of things that the government or the Federal Reserve can do to either expand and grow our economy or contract and decline our economy. Make sense? Till next